China's August 2025 trade numbers are in, offering a revealing snapshot of the world's second-largest economy at a pivotal moment. These figures reveal a shifting economic landscape as China grapples with both global and domestic challenges that are reshaping its trade dynamics. Exports grew just 4.4% year-on-year, the slowest pace in 6 months and well below what analysts had predicted. This slowdown is raising eyebrows among economists and business leaders alike. Meanwhile, imports rose only 1.3%, also missing forecasts and signaling that domestic demand remains subdued. This tepid growth suggests that Chinese consumers and businesses are still cautious about spending and investment. The resulting $102.3 billion trade surplus may look impressive on paper, but it masks underlying challenges that could threaten future growth. Slower export growth means fewer Chinese goods are reaching global markets, raising concerns about the sustainability of China's export-driven model. This trend could have ripple effects for supply chains and trading partners worldwide. The modest import growth highlights a cautious domestic economy, with factories scaling back production and consumers holding off on major purchases. This hesitancy reflects broader uncertainty about the economic outlook. These figures suggest China's trade engine is facing real headwinds, both from global uncertainty, like shifting demand and trade tensions, and internal pressures, such as slowing investment and consumer confidence. For policymakers, this is a wake-up call. The era of rapid, easy trade growth is over, and new strategies will be needed to adapt to a more complex environment. Navigating this new environment will require tough choices, innovative thinking, and a willingness to confront both external and internal challenges head-on. August's trade slowdown isn't an isolated event, it's part of a clear trend. Export growth dropped sharply from 7.2% in July to 4.4% in August. Imports fell even more, from 4.1% growth in July to just 1.3% in August. This signals weakening demand both abroad and at home. The trade surplus, while still huge, has fluctuated, reflecting shifting global demand and domestic fragility. The consistent decline in both exports and imports shows that China's economic headwinds are intensifying. For leaders aiming for 5% annual growth, these numbers are a stark warning. The resilience of China's trade sector is being put to its toughest test yet. The most dramatic figure in August's report is the 33% plunge in exports to the US, a collapse, not a dip. This isn't just a minor fluctuation or a temporary setback, it's a seismic shift in the world's most important trading relationship. For decades, the US has been China's single largest export market, fueling the growth of countless Chinese factories and supporting millions of jobs. Now, that engine has suddenly stalled, sending shockwaves through the entire Chinese economy. High US tariffs, some up to 30%, have made Chinese goods less competitive, pushing American companies to seek suppliers elsewhere. These tariffs, imposed during the ongoing trade war, have raised costs for importers and forced many US businesses to rethink their supply chains. As a result, American buyers are increasingly turning to countries like Vietnam, India, and Mexico for everything from electronics to clothing, bypassing Chinese manufacturers who once dominated these sectors. Ongoing threats of even higher tariffs create uncertainty, making U.S. firms hesitant to commit to Chinese suppliers. The unpredictability of future trade policy means that long-term contracts and investments in China now carry significant risk. Many companies are choosing to diversify their sourcing, not just to avoid tariffs, but to protect themselves from sudden policy changes that could disrupt their business overnight. This shift is visible in the data. Global supply chains are rewiring away from China. New trade routes are emerging, and countries across Southeast Asia are seeing a surge in manufacturing investment. Factories that once operated in China are now opening in places like Vietnam, Indonesia, and Bangladesh, as companies look for lower costs and fewer trade barriers. For Chinese factories, the loss of U.S. orders means idle lines and job losses. Entire production lines that once ran around the clock are now sitting silent. Workers who relied on steady export demand are facing layoffs or reduced hours, and local economies built around export manufacturing are feeling the strain. The drop in U.S. exports is a major reason for China's overall export slowdown. With fewer goods leaving Chinese ports for American shores, the country's total export numbers have taken a significant hit. This slowdown is not just a headline, it's a real challenge for policymakers and business leaders trying to keep China's economic engine running. Even as China diversifies, the loss of the American market is a blow that's hard to replace. The sheer scale of US demand is unmatched, and no single country or region can immediately fill the gap left by shrinking American orders. Chinese exporters are scrambling to find new buyers, but the transition is neither quick nor easy. The US-China trade relationship, once a pillar of China's growth, is now a source of anxiety. What was once a symbol of global economic integration has become a battleground of tariffs, negotiations, and uncertainty. Both sides are feeling the pressure, but for China, the stakes are especially high. This dramatic shift underscores the risks of over-reliance on a single major trading partner. When so much of a country's export economy is tied to one market, any disruption, whether political or economic, can have far-reaching consequences. China's experience is a cautionary tale for exporters everywhere. China must now urgently find new markets to fill the gap. The search for new trading partners is underway, with officials and businesses looking to regions like Africa, South America, and the Middle East. But rebuilding lost export volume will take time, and the road ahead is filled with challenges and uncertainty. While U.S. trade falters, with American ports seeing fewer shipments and exporters facing mounting challenges, the global trade landscape is rapidly evolving. The slowdown in U.S. demand has forced many exporters, especially in China, to look for new opportunities beyond traditional Western markets. In response, China's exports to Southeast Asia surged 22.5% in August, a remarkable jump that highlights the region's growing importance as a trading partner. Chinese manufacturers are pivoting to ASEAN nations, forging new business relationships, and signing deals that strengthen economic ties across Asia. They're tapping into the region's rapidly expanding economies and a rising middle class eager for new products, technology, and consumer goods. This shift is part of a deliberate diversification strategy, as Chinese companies seek to reduce their reliance on Western markets and spread risk across multiple regions. By building new logistics routes and supply chains closer to home, companies are finding fresh growth engines and adapting to a changing world. Some Chinese firms have even set up factories in Southeast Asia, investing in local infrastructure and creating jobs for local workers. They export components from China for assembly abroad, sometimes bypassing tariffs and taking advantage of lower production costs in the region. This deepening regional integration is transforming China into the hub of a new Asian manufacturing network, connecting supply chains from Beijing to Bangkok. However, despite these gains, Southeast Asia's growth can't fully offset the loss of the vast U.S. market, at least not yet. The scale and purchasing power of American consumers remain unmatched. Still, this shift demonstrates China's remarkable adaptability and willingness to innovate in the face of global uncertainty. The geography of global trade is shifting, with new routes and partnerships emerging across Asia and beyond. The future of China's exports may depend more on its neighbors than ever before, as Southeast Asia rises to become a key player in the next chapter of global commerce. The trade war's uneasy truce continues, with both sides extending their tariff pause for 90 days. Tariffs remain up to 30% on Chinese goods entering the U.S. and around 10% on American goods entering China. This truce offers little certainty. Businesses can't plan long-term, fearing a sudden return to tariff escalation. The core issues, intellectual property, technology transfer, market access, remain unresolved. For Chinese exporters, the pain continues. U.S. tariffs keep their goods expensive and less competitive. The truce is a temporary bandage, not a solution. Until a real agreement is reached, the threat of renewed trade war will hang over global commerce. The world's two largest economies remain locked in a costly stalemate. China's challenges aren't just external. Its domestic economy is under strain. The property sector, once a growth engine, is in crisis. Developers are deep in debt, construction has stalled, and home values are falling. This has shaken consumer confidence, leading to weaker spending and sluggish retail sales. Local governments, reliant on land sales for revenue, are now cash-strapped, limiting their ability to stimulate the economy. The result: less investment in infrastructure, fewer jobs, and a drag on growth. These internal pressures are reflected in weak import numbers and cautious consumer behavior. China is fighting on two fronts: global trade headwinds and a cooling economy at home. Achieving the 5% growth target will be a major challenge. Policymakers must balance stimulus with long-term stability. China's import data reveals the economy's shifting gears. Imports of computer chips and industrial metals fell, mirroring the construction slowdown. Yet energy imports, oil and natural gas, rose, showing that some sectors remain robust. Iron ore imports stayed high as steel mills prepared for peak season, despite the broader slowdown. Soybean imports hit a record for August, mostly from South America, as buyers avoided US supplies due to tariffs. These trends show how China is selectively sourcing what it needs, adapting to both economic and geopolitical realities. The import mix highlights a complex economy. Some sectors are shrinking, others are still powering ahead. Global trade flows are being reshaped by China's evolving needs. Analysts see China's export resilience lasting longer than expected, but the outlook is clouded. Massive government stimulus is unlikely, given local financial constraints. Instead, Beijing may use targeted credit and monetary easing to support key industries. The decline in imports of construction materials is a clear sign of domestic weakness. Meanwhile, export growth to Southeast Asia is partly driven by Chinese factories moving abroad and importing components from home. The data reveals a strategic restructuring of China's trade relationships. Policymakers are walking a tightrope, stimulating growth without piling on debt. The headline numbers mask a deeper transformation in how and where China trades. The world is watching to see how China adapts to these new realities. China's trade slowdown has global consequences. For Chinese workers and businesses, it means fewer jobs and more uncertainty. For the world, weaker Chinese demand hits exporters everywhere, from Brazil to Germany. Global supply chains are being redrawn, with companies diversifying away from China to manage risk. This shift brings short-term costs and inefficiencies, but also new opportunities for regional trade blocs. The era of China as the world's unstoppable growth engine is evolving. How China navigates these challenges will shape the global economy for years to come. The world is entering a new phase, one defined by adaptation, resilience, and shifting centers of economic power.